to the European Chamber webinar Wednesday. A very special word of thanks to our guest speaker, Mr. David French, who is the Director of Tax Consulting at Mazars and has many years of experience in what he does. What we're hoping, David, is that we will not have any unscheduled power cuts today and that it goes smoother and people will begin to join us. And word of welcome for those of you that are already online. If you have any questions, please send it to us on the chat or towards the end, or if you want to interrupt David, just put your hand up and then we'll unmute you so that you can just ask the questions. So without further ado, I think let's start doing the recap, if you don't mind, please, David. Thank you.
Thank you very much, and thank you for the kind words, and thank you for those people who've come back to me. Well, the plan is to run through the first few slides that I had done. I'm just looking at it now. I only have 10 slides in total anyway, so we'll run through them quickly. Again, for those people who have heard it before, my apologies. I'll see if I can give it a different slant, or if you have a question now, please go ahead and ask questions. I have now managed to work out how to put a chat screen up so that if something comes up live, I can see it and address it. Yeah, the idea of this is to tailor discussion more for the chambers and for people who are inbound investors. I look at it both from a corporate point of view as well as a little bit from the individual point of view, because I know that that's of interest to everyone. It's not just budget speech stuff, because that is done to death, partly by our really experienced speakers that we have at our budget updates, Di and Daniel, and I can't even try and upstage them. But the idea is, with the budget in mind and various changes, also what do I see out there when I'm consulting with various people, particularly on inbound investment, and then what are the types of changes we're seeing. So that's where we're going to go today. Right, let me see if I can make this work. Yes, there we go. On my agenda, exchange control, because everyone forgets about it. It's the kind of the forgotten stepchild in the area. Not really taxes, but I do a fair amount of consulting in exchange controls. Value added tax is, like I call it, the rats and mice taxes. One of my former colleagues will tell me that I'm a purveyor of antiquated taxes because I look at the individuals, the normal tax, the income taxes, whereas value added tax is a tax of the future. He's probably right in many ways. Then we look at the normal tax or the income tax, both individuals and corporates. So let's start with exchange controls, and as promised, individuals. The budget speech, and we're now working wholly with this, has talked about the relaxation of some of the immigration rules. So if we're throwing people out of the country, this is not coming in. In the past, I would always tell people you have three personas. You have your citizenship, your passport, you have your tax persona, and you have your exchange control persona. They might be somewhat integrated, well, somewhat related, but certainly not integrated. What exchange control are doing now are they're integrating the exchange control persona with the tax persona. So if anyone is resident in South Africa from an exchange control point of view, how we get you out of the country now is at the same time as you do your tax emigration, rather than a separate formality that we were doing in the past. And you could be non-resident for tax purposes, but still resident for exchange control purposes. Now, this does create some interesting thoughts for me going forward. I take, for instance, my brother, who left the country and certainly tax emigrated in around 2000, but he never went through the process, the formal process for exchange control immigration. So the question now is he or isn't he? Has he gone because he tax emigrated so many years ago, and definitely did, because we did that process. But for exchange control purposes, is he now, or do we have to go through another process to throw him out of the country from an exchange control point of view? So some interesting things will come up out of this. We are looking at this with a number of people at the moment. And again, SARS have had to change their systems in order to bring this into account. We're hoping they've got it right. We will see as we go along. So that's my focus and my interlink with the tax immigration at the moment. The other mention in the budget speech was the phasing out of loop structures. This is for individuals and corporates, so I threw it under both at the same time. The idea here is that in the past, we have had the so-called loop structure, which is strictly forbidden for exchange control purposes. Again, it affects more my residents here, but it does affect a corporate that is incorporated in South Africa. So I could have a company incorporated in South Africa that has a subsidiary or another company outside of the country, which then has an asset, owns an asset that is located in South Africa. It could be another company or could be other assets, whatever it might be. Those were forbidden in the past. If you had, under certain circumstances, you could get approval if it was inadvertent, but certainly the exchange control did not like it. So we have a South African resident owning a foreign company generally, which then owns South African assets. That's the so-called loop structure. Going forward, those are being phased out. So you will be able to enter into those. Any historical loop structures still need, what's the word I want? Condonation or authority from the exchange control authorities. But going forward, you're not going to need it under most circumstances. So that is good news for us. Particularly, there's a number of cases where it's inadvertent. People don't realize that what's happened. It's through, they might acquire another company offshore which has South African assets which they didn't realize, and there was a problem with that which we had to rectify. So that's good news. There's a couple less pieces of red tape that we need to worry about going forward. Then under the corporates, there are just no other changes at this point in life. We still have things like if I'm an FDI, so I'm a South African company, I'm owned by a non-resident company. My offshore, if I'm borrowing from offshore, I need to put that on record with the exchange control authorities. It's something that people often forget to do. It doesn't really affect them until they want to pay money away offshore. So they bring the money in as a borrowing, they forget to put it on record. That's normally done these days if you're within the parameters by the authorized dealer. We don't even need to put an approval up to FinServ, the exchange control authorities. But we forget to do that very often. Or we borrowed, we didn't borrow, we took credit. There's trade credit, which is then left outstanding and becomes a borrowing because it's no longer trade credit because the offshore group is helping out here in South Africa, and it goes longer than a year, becomes a borrowing rather than merely trade credit because it's gone beyond the days we need to regularize that before we can pay it away. So it's just something to keep in mind as we go along, still in place, still have to go through the formalities. The other one that people forget about is if I'm more than 75% owned by an offshore company, I can't just go out and borrow locally. Generally, in this case, the authorized dealers know about this because you're going to them to borrow, And there are certain restrictions on that, and that still remains in place, and we keep an eye out for that. And our local borrowings of an affected party, again, as I say, affected party is 75% or more owned offshore. The other one is endorsement of shares, which is always fun when my non-resident, for exchange control purposes, as we're talking about that now, invests in a company in South Africa. There's just the formality of having the share certificates endorsed by the authorized dealer. A couple of hoops to jump through. Generally, we want to see the inflow of funds into South Africa if we're investing in the shares in South Africa. So for the subscription of the shares, we want to see that inflow. The authorized dealers need to be able to see that. And then they physically still put a stamp on the share certificates and sign it and say endorsed as non-resident. Importance of that again comes when I want to flow money offshore. If I have a dividend I want to pay offshore, as long as my shares are endorsed non-resident, there's no issue with paying away the dividend. If they're not endorsed non-resident and you go to the bank and say, I want to pay this dividend to my holding company, the bank will say, where's your non-resident endorsement? And we have to go through the hoop of getting that endorsed. So it's still in place, still something we have to do. Just the last comment on this, as we go along, the authorized dealer is given wider and wider discretions every year. In the past, just about every decision had to be made by, as I call them, FinServ, the Financial Surveillance Department of the Reserve Bank, the exchange control authorities. Now, more and more of those decisions are made at the authorized dealer level. So it is helping to free things up. Things do get a lot faster with that. So that's been a useful thing in the exchange control space. That's exchange control in a nutshell. So let's look at value-added tax. And that's my comment. There's been no major changes in the system over the past year. Certainly, the National Treasury do not want to mess with it too much, if we want to call it that. They've shown they believe it is an efficient system. It is doing its job for them. You hear about the and that type of thing. And there are issues around it, as with any tax. But on the whole, South Africa have a good, efficient system. The only interesting thing about it is if we look at our value-added tax rate, currently 15% or 0%, as you know, on the zero-rated goods, it is slightly lower than our peers in the system. So I don't, from a political point of view, I don't expect to see an increase in rate because it is regressive. It does affect the poor much more than it does affect the rich. The rich can afford, they do spend more on VAT, but they can afford to pay more on VAT than the poor can. So I don't expect to see too much change, but that's, we see as it goes forward. Just to remind everyone, the turnover threshold for VAT registration is 1 million rand. It's not that high. If you want to voluntarily register, it's 56,000 rand. The only difficulty with registration that we find is you have to demonstrate that you are going to make that money. So you have to have some sort of contract in place, have to have something that you show that is going to go. The revenue authorities have been fairly sticky about getting registered. Again, because they've experienced a lot of people registering in order to defraud the system. So they're fairly rigorous about the registration requirements. We need to register you from the date when, if it is a compulsory registration of 1 million rand, from the date that you would have gone over when looking forward for a 12-month period. So they do allow retroactive registration as a vendor. That does bring with it certain complications. I prefer to register you as soon as possible. The retroactive registration then means that I have to go back and I have to do tax returns for those periods. Often we do that under a voluntary disclosure program so that we don't end up paying penalties on the underdeclaration of the output tax for those periods. it does get rather complicated and can be somewhat messy in certain circumstances. So it is something we need to consider very carefully. I've had to consider this with a couple of people. Someone wants me to go back, I don't know, about 6 or 7 years, I think, and register. They've got special circumstances under which they can. Fortunately, we weren't the consultants to them. We've just become the consultants to them. And we're needing to look at that and see how do we do this properly. But it does get very messy if we want to go back. As I say, I want to rather register you from the moment that you should be registered. A lot less messy, a lot less worry about penalties and interest. Right, let's talk about our enterprise. This is something we've been seeing a lot of over the last couple of years. And this affects not so much the guys on the call here who are working in South Africa, but it may affect someone else in the group who does have some sort of presence in the country. So for VAT purposes, you become a registrar if you have an enterprise partly in the Republic. And an enterprise looks at your activities in the Republic. And we can look at this now over the next couple of points. Obviously, if I have a branch in the country, it is affected. And if there's a branch and there's activities in the country and I'm doing things, I'm quite likely have an enterprise in the country unless I'm not earning any consideration from those activities. So it's purely let's call it a market research branch or something like that. May not be, but as soon as I start earning some sort of consideration from these activities, I'm looking at having this enterprise partly in the Republic. But what if there's no branch in South Africa? And this is, I'm seeing a case at the moment where I've got a foreign entity that is bringing certain goods into the country. These goods are being finished in the country by an unrelated third party in this case. So this unrelated third party finishes off the goods. So the last part of the work is done on the goods in the country. The third party then delivers to the ultimate client in South Africa. But the third party invoices my foreign company, my foreign resident, for the work that it's done. And the foreign resident has the contract with the South African client for the delivery of those goods. This has created an enterprise partly in the Republic for that foreign company. And on all the sales it makes to its client in South Africa, it should be registered and accounting for the VAT in respect of those and raising VAT on it, where in the past it wouldn't have raised any South African VAT. So you can see how having someone doing something to the goods in South Africa creates that enterprise partly in the Republic for my person who is otherwise non-resident. Raises a number of interesting issues around cash flows and what I raise on whom and all the rest of it. But that is something we have to keep in mind. Another case recently also looked at a South African distributor who was distributing for a foreigner, but it was consignment goods, as I remember it, and that also created an enterprise partly in the Republic for the foreign party. So there's some strange rules within the VAT realm that can bring you in when we're talking in the physical space here. Obviously, in the digital space, we've got the so-called digital rules where the likes of your Googles and your Amazons and your the iTunes store that's selling digital goods into the country have had to be registered for a while. Now it's widened to other service providers in the business-to-business side. It started as business-to-consumer. Now business-to-business also includes it. But this here we're looking in the physical space, which people often overlook. And we've had a number of cases where, from a VAT perspective, a non-resident has had to register. So that's something to keep in mind. That's the value-added tax. So let's look briefly at income tax for individuals. The fun side of the budget this year, I'm sure everyone knows about it. By this stage, the tax brackets have been expanded in line with inflation. So there's a little bit of relief for people in that. It's not huge, certainly not in the higher ends of the brackets, but it was a nice surprise from us who are in the field from the minister, because we weren't expecting him to do it as much as he did. So that was good. Other things I want to talk about, we have many non-residents in the country, individuals who come out here, expatriates, they're here for a couple of years, they are going to leave. I'm working from the basis that the person will be leaving the country, and at some point. I know this is a very variable thing, and I've seen some people come for 1 year, 2 years, 10 years later are still here. Sometimes they then change their mind and they want to settle down. Other times they're still going to go. It's very fact dependent, but let's work on the fact that we're expatriate, we will be leaving. So you're not a resident for South African tax purposes because you're not ordinarily resident in South Africa. So we seek to tax you on your South African sourced income, which is generally your salary, because you perform the services here in the country. That leads to a number of interesting issues, which we can touch on as we go along. Then we have our double tax treaties. Now, South Africa has a nice treaty network, around 80, and I say around because I haven't bothered to count again recently, but certainly we had hit 80 at one point, and I don't remember any more coming in, and none have been terminated. So we've got about 80 double taxation treaties around the world. They follow on the whole either the OECD or the UN models. I'm not going to go into the differences. There's not too much difference, mostly in permanent establishment. Some of them contain additional clauses with regard to what's it called, management fees or technical fees where they give protection. That's normally in our UN model treaties with African countries. But on the whole, fairly standardized wording. Of course, the outlier in any treaty network is the US, which follows the US model. And we won't even talk about that today because that's always fun. But the 80 treaties. Our treaties will tell us that on the whole, South Africa will have taxing rights in respect of salaries of expatriates working in the country. Now, the treaty protection in a source country is restricted to if the person is in that country for less than 183 days and someone in that country does not pick up the deduction for the expenditure. So it is really looking at someone who is sent over to South Africa for less than 183 days and there's no South African deduction for the salary. That makes sense. Then why should South Africa take the taxes if there's someone here on a short-term basis? But so the treaty protection for salaries is fairly limited across the board in OECD and UN model and the US model treaty. Okay. Then I want to talk about the physical presence override in all of this. In South African domestic law, you will hear, particularly the people who come into the country, your first 5 years, you're all right, but then after 5 years, we've got to look at you very carefully because we've got the physical presence test. Our physical presence test looks at the number of days you're here in a year and the number of days you're inside of the country over a 5-year period. Don't ask me to for those exact days because I can never remember. It's 90 days a year and 500 and something days over the 5-year period. It then says if you are inside of South Africa for those days, and we look at your passport stamps and all the rest of it, then you become resident in South Africa because you were physically present in the country for those days over that period. And there's a lot said in the market about that, and people say, yeah, you're physically, you become physically present resident, and now you become tax resident in the country. But what people often forget is a little proviso in the definition of residence for South African, for an individual. In fact, it's for individuals and for corporates in the residence proviso. And from a individual point of view, well, from both points of view, it says if you are deemed to be resident in the other country exclusively because of a treaty with that country, then you do not become resident in South Africa. So whilst the physical presence test might kick in and say, I'm thinking that you are a resident, we still have to look at it on the basis of the treaty and on the basis of the domestic law in both countries. Now, again, our treaties follow fairly much the same sort of test as our domestic law of ordinary residence. And they look at it and they say, where are you planning on going back to? Where are you planning on living out your life, if we can find that? And very often in the expatriate field, the person is going back, they're keeping some link with their home country, and their home country still thinks that they are resident there. In that case, you cannot become resident in South Africa because of your physical presence, even if you go beyond the 5 years. Obviously, we have to continuously look at it because it is a factual thing. And if you ever turn around to me and say, well, you know, I'm actually thinking of settling down here, I go, well, then in that case, you're becoming a resident of South Africa, but not necessarily because of the physical presence test, but because from an ordinary residence point of view, you're thinking of settling down here, you are going to become ordinarily resident in South Africa. So that's a complication in the whole presence. But as long as the home country and is a treaty country, number one, and continues treating you as a resident based on domicile, based on your ordinary residence or something like that, the likelihood of you becoming resident in South Africa is quite low. So that's where we go with that. Right, that's my individuals. Run through all of that very fast. Let's talk about my corporates. Where am I? I'm at 11:40. Just no one's asking me any questions yet. Please, I'm happy for people to interrupt me. Put a message in the chat saying, stop, David, because I want to ask you something or something along those lines. My corporates. Alrighty, the fun part. I mentioned earlier that our VAT rate compared to peer countries, Treasury has said it's looking slightly lower. Our income tax rate is looking slightly higher than peer countries. I have been trying to, and I've actually gave up on it because I had other work that actually pays me, but I was trying to look at it and look in the context of the BRICS, look in the context of developing countries, and my view is our tax rate is not far off of many of those countries at 28%, interestingly. We could always do with the tax rate reduction. When we're looking at inbound investment, we're always looking to compete with a whole bunch of jurisdictions who want investments. And from a tax perspective, I mean, that's one of many various aspects that we have to look at. But a tax rate is always a good place to start. So the 1% reduction is welcomed. I'm going to talk about that in a fair amount more detail as we go along now, because I'm not sure it helps in a lot of cases. It helps us with an established company, with a company that is in a tax-paying position, that is not needing to be funded too much, paying taxes. Yes, certainly a 1% tax rate is a great thing. So that's a good start. Interesting thing about it is, whoops, I just went the wrong way. Helps if you hit the correct arrow button. It's in respect of years of assessment starting on or after 1 April 2022. So the first year that you have a rate reduction is in your year ended 31 March 2023. So whilst they've given us a rate reduction, a little bit of a marketing ploy there from the minister, yay, rate reduction. When's it from? Oh, okay. 1 March 2023 is the first year. 31 March 2023, the year ending then is the first year it will affect us. What I want to point out, I haven't put it into my slides, but it's come up. If you are in a deferred tax asset position and we're looking at accounting, my colleagues in IFRS are having a field day at the moment because we have a rate change that is substantially enacted, because if the minister stands up and announces it in the budget speech, we can be fairly much assured it's going to happen, even though it's so far in the future. It will be brought in. That is just how the political system works and the announcements work in South Africa. So it is substantially enacted. If I have I nearly say exchange, it's a deferred tax asset that I'm looking at. I obviously bring it in at my tax rate, which is either 28% or 27%. If it's substantially enacted, then it's at 27%, except for I might utilize some of that asset in a year of assessment that ends before that 31 March 2023 point, in which case I have to value that portion separately and account for that at 28%. So this does create some complication over the next year or so in our deferred tax calculations, where we're looking at. So someone has gone unmute on me. Okay, translating. So that's the case with the tax rate decrease. That gets us into, well, when we're putting our taxes together, let's have a look at some of those new rules around what we can and can't deduct. And this year it's all about what we can't deduct anymore, although I make the point, my interest limitation rules are not new. They have been around for a while. What is being proposed as some tweaks to the interest limitation rules, partly to bring us more in line with the OECD base erosion rules on interest limitations, and also partly because the National Treasury, while they're giving us 27%, they still have to make money, and they're looking for ways to just bring some cash in on an earlier basis. I'm very cynical about this. Just as a matter of history, I have been involved in interest limitation rules on the BEPS project and in South Africa. Why I say not new, we brought in section 23 cap M and 23 cap N, but M is the one that we're really worried about. A number of years ago, I was integrally involved in drafting of that. I worked for the revenue authorities at the time. I was working with Treasury to bring something in. It is a thin capitalization type rule. It is there for a number of purposes, and then our interaction with the OECD at the time. We managed to get the OECD to come on board, if we can call it that. They were looking at a group rule more than individual companies, which would not have worked as far as we were concerned. And we sort of got things aligned. Now Treasury are talking, they are re-looking at the interest limitation rules. Our current rules, well, the current and the new rules, will still look for related party relationships. So it's known as a controlling relationship in this rule. There was a time in the past year where Treasury were looking at non-related party relationships as well, and we went back to them and said, that's crazy, because why are you looking at it from that? If I go to the bank and I borrow from a third party, why would you limit my interest other than just trying to raise more money because you're denying me the deduction now? The second part of the rule is the interest is not subject to tax in the hands of the recipient. Again, you can see, and this is what, in broad terms, what the base erosion rules are looking at as well, the BEPS rules from the OECD. If we manage to get the interest not subject to tax in the hands of the recipient in one place, that is deductible in another place, then it doesn't look good. Are subject to tax, was subject to tax in South Africa. My view is if that interest was subject to the withholding tax on the way out of South Africa, so it was going to a jurisdiction in which with which we didn't have a treaty that reduced or didn't subject to tax the interest, the withholding tax, then it is subject to tax, and the rule would not kick in to limit the interest in South Africa. So the whole concept then was, if it was not subject to tax in South Africa and paid to a related party, then we would limit the amount of deductible interest to an amount based on a percentage of the tax earnings before interest and tax, obviously before interest and tax because it was tax earnings, but a kind of modified taxable income. Where we added back interest and we did a whole bunch of things and it made it rather complicated. And that limitation was based and moved with the repurchase rate set by the Reserve Bank. So that's the repurchase rate is the rate for borrowings of last resort by the banks, and set and announced every month by the Reserve Bank, and there's a formula that allowed it to move with that. On top of that, we were actually very nice about this. We said if we disallowed the interest in year one because it was in excess of this percentage, you could just carry that forward. So it might create you some taxable income in year one, but in year two, year three, as you start making money and you get more taxable income and your taxable EBIT moves up and your ratio moves up, you can deduct more and more of that interest. And in theory, over time, if you are a profitable company, you get the entire interest deduction, just you have the limitation. That is how the current rule stands, and we see how it goes. Okay, under the new rule, as I said, it remains the connected party interest, but it may include interest that is taxable in the hands of a recipient. So we're waiting for the latest draft of what is going to be. We had a rather large meeting with National Treasury during the latter part of last year, where we gave feedback to Treasury on various things. But this is still something that worries me, because if I have two connected parties in South Africa, and one of them is taxed on the interest, and the other one seeks to deduct that interest, from a South African perspective, why should that deduction be limited? Other than, as I say, with my cynical hat on, to make a little bit extra money to spend from the fiscus point of view. I don't see why it should be. It should still be that it's not subject to tax in South Africa. However, we wait for the results of all our discussions to come out. Some of them have been mentioned in the budget speech. Many of them haven't. Okay, the scope of the rule will be expanded to include items similar to interest. This is a reaction to really bankers are very creative people and treasurers and that, and they tend to, oh look, if I'm not going to have a withholding tax on something that is not interest, I'm not going to call it interest, but it kind of looks like interest. So we're waiting to see what the actual rule will be, but this is a fairly common inclusion in any interest taxing provision, that items similar to interest will be included, so that you can't kind of rename your interest as something else, but it is interest actually. So that's the, okay. Again, it's fairly similar to the past. It's the net interest expense that is limited. So if you have interest income that seeks to reduce the amount that is subject to the interest limitation, if you have interest income that exceeds your interest expense, your entire interest expense will be deductible. If you have net interest expense, then we look at the deductibility of that and the limitation. And then, as I said previously, we had this kind of floating rate based on the repo rate. We're looking at restricting it to 30% of earnings. How this is going to affect us is often we have in our FDIs, in our startup companies, these are the people that I'm worried about and where I do a lot of work with. They often are in a borrowed position. They have borrowings, they have interest paid out. This obviously affects them quite badly. What I didn't put into the slide is, because I wasn't able to confirm, I know originally there was a move by Treasury in their paper to make this limitation a permanent limitation, so you couldn't carry it forward into the future. There was a lot of pushback, and I haven't seen any comment about that, so that worries me. If this is a permanent limitation on a new company that's starting out, it obviously doesn't have any taxable income or very low taxable income at this point in life. You can see that I'm losing my interest deductions. It does not make sense from that point of view. We may as well just capitalize the entire company with equity. So we need to look at that and see, how do we deal with that going forward? It could have quite an impact from my cash flow point of view going forward and things. Talk to that in conjunction with what I'm going to talk to next, which is the loss limitations. Also proposed a little while back, but because of the pandemic was postponed. And this is undoubtedly a cash raising exercise from the government. This, I can't, whilst I say I'm cynical about it, I can't moan too much, because on the other hand, our individual income tax rates haven't gone up, and they've given us the benefit of inflation in the what's it called, the buckets, the tax rates, in the tax table, and all the rest of that. But this is most definitely how the government wants to upfront slightly some of its cash collections. So what do we have? In South Africa, we have an indefinite carry forward of losses, provided that I'm trading and effectively I'm earning income from the trade. But if I make a loss in year one and I continue making losses over a number of years, that year one loss is never forfeit as long as I am continuing to trade. And I can set that off against my profits or my tax profits in the future when I start making tax profits. Okay. The proposal is that in that year in which I start making tax profits, I cannot use the losses to protect 100% of my taxable income in this year. I can only use it to protect 80%. So let's say I've been making losses for 3-4 years, and in year 5, I start making taxable income, and I make a nice taxable income, and I will put up a little example of this now. Year 5, I start making a taxable income. In the past, I could have used, if my taxable income was less than my accumulated losses, I wouldn't pay any tax. Now I will pay tax on 20% of that taxable income. Again, these are proposed to come in from next year, 2022, if I remember correctly. I don't think I put it in, I can't remember. So the remainder of my loss gets carried forward into the new year. And I can, again, I'm not going to forfeit that loss. I am just going to carry it forward as long as I need to in order to utilize it. So let's put some scary numbers on the screen. Hopefully everyone can see that. Assuming I have tax losses at the beginning of year 1 of 500 Rand, and I have taxable income, I made it easy over 7 years of 700 Rand, 100 Rand a year. We can see under the old rules, over the first 5 years, I could set off 100 Rand of my losses, and I wouldn't pay any tax over those 5 years. In year 6, I would pay 27 Rand. In year 7, I'd pay 27 Rand because remember my rate has come down in those years, and for my total of 54 Rand over the 5-year period that I'd pay. Under the new rules, you can see I don't get 100% protection. I pay 5 Rand in the first 4 or 5 years. In fact, in year 6 as well, as this pans out. And then I pay a little bit less tax in year 7 because I had some losses still to carry forward. I pay my 54 Rand of taxes over the period, but you can see I've brought that forward by 5 years that I'm paying. Now think about this. If I'm in the startup scenario, we're looking at losses for the first couple of years. I'm looking at limiting my interest deductibility over those years as well, and potentially not getting any deduction for it. Then I go into a tax-paying position and I have to have cash to pay. Now, in the past, I wouldn't have had to have funded my tax payments as well. Now I have to fund my tax payment of 5.4, and I need to I have to pay my tax payment, and I might have a limitation of that interest because I'm still not yet in a fully tax-paying position where my interest income is beyond or is less than the limitations. So this is for us quite a problem for my startups, for my foreign direct investments, where we're seeing these restrictions affecting us. So that is, for me, out of all of this, that is my major issue in our current situation going forward. This is the thing I wanted to bring through the most. The loss reductions, they're coming in from next year. The interest limitations will be covering us as well from next year, and we will see where we go. So where I have a company that is mature, that is in a tax-paying position, wonderful. I have my 27%, my rate reduction from 28 to 27, but where the government is going to make up for that is in my startups and in my loss-making companies, and my companies that are required to have interest or borrowings and are paying out interest. It leaves me with just the minister in his speech said that the 27% rate would be done on a revenue neutral basis. Again, wonderful marketing ploy, sounds great. How does that affect us? Well, revenue neutral for the government, because they're going to give your established companies a tax break, 1%, but your startups and your companies that are required to be funded are going to be in a worse position. Not sure that's great for our economy, but we'll see where we go. Something to be thinking about, as particularly on top of the various, what's that word I want, transfer pricing rules that we have and cross-border issues that we have when we have the investments into the country. That's my update in a nutshell now. I've left just enough time to have a chat. If anyone wants to ask me questions, happy to answer questions at this point and see where we go from there. And I see that Mr.
David,
has
thank
left.
you. Yes, David, thank you so much for this. Ladies and gentlemen, if you'd like to put your hands up and just ask David a question directly. But in the meantime, David, I do have a question for you. As you said, there is good news that they have brought down the tax rate, but obviously we need to be careful, with regards to the use of loss limitation in any small SMEs going forward and foreign direct investors. What impact is this on non-profit organizations, like chambers, for example,
Okay, that's a completely different thing. But I'm glad you raised it, because for those people who are involved in it, the whole concept of non-profits is that they're supposed to be easier than our corporates and all the rest of that. And I do a fair amount of work in the non-profit space, and they're not. Firstly, the concept of a non-profit means that we have various different registrations or applications of it in the Act. So you're not necessarily automatically, you must sometimes have to get registered for it, and we have to check that. And that's from an income tax point of view. So from an income tax point of view, these proposals shouldn't affect us at all if we are a non-profit and we're registered with SARS and all the rest of that good stuff. And we just go forward year to year. We've got to be careful, because remember, people forget that there are a number of various rules. And again, it depends on who you are and what you are. A number of rules around what the type of income you can earn. And if you get into trading and that type of thing, it could mess you up. But that's from an income tax point of view. If you've got a registration as a PBO, public benefit organization, or if you fall into one of the other exemptions in Section 10, that's not really a problem. But then your non-profit always forgets, let's take a step back to the VAT. There's no such thing as a non-profit from a VAT perspective. So I'm currently dealing with a non-profit who actually went the wrong way on this. It's quite interesting. They are VAT registered and they raise VAT on their membership with all their members and all the rest of it. But then they raised donations. Well, they raised funding for a certain project, and they didn't know whether it was donations or not, and they raised tax invoices on it with VAT. And we turned around and said, hold on a second, isn't this donations? And donations are not subject to the VAT. But what this has done to them is now, when we look at if they're registered as a vendor, and normally they go year to year, and they raise the output tax, and they've got all their expenditure, and they have the input tax, that's fine, and they go forward. Now, these donations are so large that we have to look at whether they have to apportion the input tax now, because they've got a whole bunch of consideration, well, it's not consideration, it's non-consideration, which is not subject to VAT. So now we might have to restrict their claim of in respect of their output tax. The other thing is where you have someone who invests, that you have your money, you raise your membership fees or whatever it is, and you keep a contingency fund, and you earn interest, or you invest it and you do really well and you get dividends and that. Those are exempt consideration, and also they become part of the consideration that if you earn more than 5%, if that's more than 5% of your total earnings, then you start getting into this whole concept of apportionment. So yeah, public benefit organizations, non-profit organizations, they scare me, because whilst the rules should be simple, they're not. So it is something that it's worth keeping an eye on in many cases.
Okay, thank you. Thanks for that. Yes, ladies and gentlemen, any other questions for David? In the meantime, I do have another question for you, David, if you don't mind.
I'm going to start charging you fees. Everyone else, I'll answer their questions.
With regards to trusts, How
Yes.
will this new tax bracket and law affect trusts going forward?
Okay. Tax brackets not. Trusts are taxed at 45% of their taxable income. Remember that the revenue authorities do not like trusts. There are various reasons for that. Again, some of my history, I was in the anti-avoidance field where trusts come up a lot. And one day I was pulling on strings, let's call it, when I was working on the other side. And I was following through a variety of transactions in a structure. And I got to a trust and I couldn't find anything else. Whilst trusts are very useful tools for various planning and things, our administration of trusts in South Africa, remember that a trust is registered with a master. We have how many masters of the Supreme Court around the country? Their records are a mess. So from the revenue authorities' point of view, they hate trusts because trusts end up in dead ends. And literally this happened to me many times. Then also, when I left the revenue authorities, one of my colleagues was doing a project. One gentleman had managed to set up 400 trusts around the country. 400. Why? I mean, these things cost money to administer and things. And there was one very big reason for that. Things were being hidden in them. So for those reasons, the revenue authorities don't like them. So they've tried to kind of stamp them out. Well, not stamp them out, but make them difficult to use from a tax point of view. So it's a 45% rate in the trust. If you've got capital gain, the inclusion rate is 80%. It's the corporate rate, not the individual rate. Just trying to make them a little less attractive. Also remembering if you make an interest-free loan to a trust, we've got 7 cap C, which will deem the interest to be a donation on an annual basis, just making it difficult. Having said that, trusts are useful tools, are very useful tools. And in the right circumstances, I personally run, I have a property in a trust. It's to keep it separate from the rest of my assets. There's a good reason for it, and the way I do it, I'm quite happy with it. I do have a capital gains tax issue if I ever do sell the property out of the trust in the future, because it will be at 80%, and I need to look at, the inclusion rate's at 80%, and I need to look at that. And a tenant in the past has offered to buy the property, and I said no, because it doesn't make sense for me to do that. It does stifle sort of selling and reinvesting. So there's all sorts of things, but there are good reasons for having a trust and setting it up properly. The loss limitation rules will affect the trusts in the same way as they do affect a corporate or anyone else that you will be flowing it through, and you'll pay tax earlier in the trust if you have a trading trust which is paying tax. The interest limitation rules will affect it in the same way. Trusts are interesting beasts, useful. Also need to keep an eye on them just from a tax perspective. But there won't be any special change to trusts because of these rules. They'll be affected in much the same way.
Okay. Thank you very much for that. Ladies and gentlemen, your last opportunity to ask David any questions. I think, David, you've done such a good job that they don't really need to ask you any questions. So I want to take this opportunity of thanking you. Not at all, not at all. I just want to take this opportunity of thanking you. We will be sending out the PowerPoint slide in a PDF format and the recording of this. And I do invite you to connect directly with David with regards to your FDIs and how he can assist with your tax issues. Ladies and gentlemen, thank you very much, David. Great pleasure having you here today. And we will be seeing each other soon. Okay.
Thank you very much for having me.
Thank you very much, everybody. Thank you. Bye-bye.
Bye. Bye.